Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange. I'm Jared Blicker, your host, and with me is Alexandra Canal, who's filling in for the voice of the people. Thank you, Allie.
Of course.
First, please like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming back Jay Woods, Freedom Capital Markets Chief Global Strategist and former floor governor here at the Exchange. Jay was our very first guest on the pilot for Stocks in Translation, and this is Jay's fifth appearance on air, not including the pilot. So if we had a big budget, Jay, there would be a free hoodie or something, but we can definitely bring out some funfetti for the occasion. Today, we're going to be talking about market technicals and how to read the market tea leaves like a pro. Our word of the day, Fibonacci. Not four words, just one. The name of an 11th century Italian monk who liked to count rabbits efficiently. No joke. We're going to tell you all about Fibonacci analysis and how it has been absolutely nailing the recent market moves. And this episode is brought to you by the number 15.9%. That is how much Wall Street thinks Mag 7 earnings will grow this year. And the rest of the market? Well, about half that much. Why big tech still needs to deliver this year. So Jay, we're going to dive into the technicals in a minute, but just tell us what you think about this recent volatility. We have climbed out of that morass early in April, and we were taping this on the last day of the month.
Well, for the traders, this has been the greatest environment ever. This reminds me of, COVID, just seeing the intraday swings. So if you are an active trader or a nimble trader and you're by your computer screen, this has been nirvana. But if you're a nervous investor and you're watching this day to day, you may want to go for a walk and just take a breath. But April is pretty much flat.
Yeah, how about that?
Considering we were down almost 15% at one point, we had the worst 3 days in a row before a nice retracement after Liberation Day. So a lot of things to digest, headline to headline. But at the end of the day, the month was down a little bit, and we hit some key levels. Traders were enjoying it, but people that have to talk about the market like us, if you're writing about the market, you'll have something in the hopper, and then 2 seconds later, the story, you can just throw it in the trash. It's been frustrating, but for market participants, a lot of fun. For people thinking about the long term and worried about the trajectory of the market, it's been a little skittish.
Yeah, things change so quickly, and it's all based on the headlines, primarily out of the White House administration this past month. I mean, Liberation Day was in April.
Mm-hmm.
We got the tariff implementation in April. I feel like we've lived so many different lives since then.
At least five.
Yeah, at least five.
Well, you were mentioning levels, Jay. So let me get to our word of the day, which is Fibonacci. This is the name of an 11th century Italian monk. He was trying to count rabbit populations, which breed rapidly, and he discovered that the formula is simply to add the last two numbers in the series together, starting with 1. So it goes 1, 1, 2, 3, 5, 8, 13, 21, 34. And from there, we get Fibonacci ratios. So if you divide one of them by the other, say 21 by 34, you get 0.618. That is also called the golden ratio or golden mean. And here's the finance part. You can apply these ratios to stock prices, highs and lows, and a lot of the time, if the market moves sharply in a direction like down, then it comes back, called a retracement, it will turn back in the original direction, which might be down, often turning very close to one of these levels. So 61.8% is a big one. If you subtract that from 100, you get 38.2%. And then in the middle, you have the 50%. That's a big one. It's not actually a fib level, at least from my knowledge, but it's huge.
Yeah.
Tell us about what's been happening with these levels recently.
Well, first of all, great job. And it was rabbits. Like, you literally watch rabbits compose. But those Fibonacci ratios are found in everything we do. Shells, your ear, from the outside of your ear to the center of your ear. The Nautilus shell. From your head to your belly button. Everyone has the same ratio, regardless of size. It's remarkable. It is a little voodoo, and I do refer to it as voodoo, but when you put it on the charts and you use it with other indicators and oscillators, wow, does it paint a picture. And then you mentioned, you put it from extreme levels. So what did we do? What did the technician do? They went back to when this bull market officially started, which was the end of the bear market, October 2022, that low. And then you put it to the extreme, which was February 19th of 2025. And you see these Fibonacci extension levels. And where did we retrace? Well, on that worst day, that worst sell-off, it went to 50%. Not a Fibonacci level, but it got within 2 points of 50% of that Fibonacci retracement.
The halfway back.
Holy moly, how did it step in? And then when it came back, it rallied back above a fib level, came in, tested 51.36. I'm within 2 points of that, but it held right to it. So I think algos are programmed into these levels, but more often than not, you see areas of support, resistance, buyers step in, sellers step in when it's going back to these fib levels. So it's important that we know them. I can't explain why. I teach this at Fordham University, and I just say, just go with me, students, and then we put fib levels in to look at possible extensions, especially when you're looking at something like crypto. Bitcoin.
Yeah,
fib levels
is a
to
great
me,
technical market.
It's what works the best when you're looking at levels in crypto and you're trying to give prognostications of where it could go, because you can extend higher, fib extension higher. So to me, it's tough to explain. I think you did a great job. But when you're looking at a big picture and you want to see, okay, where are certain levels where we may see buyers come in or sellers come in, you always throw a fib level in there, and then if it interacts with support, resistance,
you need to see participation.
Yes, and then I always like to throw in a MACD and RSIs and Bollinger Bands, but it is just unbelievable how well it worked when you're looking at cycle highs and lows and putting those fib retracement levels in. It's a head scratcher, but it's something that comes into play, and it goes back to ancient Italy and rabbits. Who knew?
Well, I'm Italian, so I love that. But what's the takeaway then? What are these Fibonacci levels telling us about the investor today?
Well, Ali, it's something that the trader wants to use just to give them a little bit of an advantage, because algos are programmed to it. There's some sort of human psyche, some voodoo, where we do get people come into the market. I can't sit here and logically explain it to you. I don't understand why everyone's ratio from their head to their navel is the same exact level. But it's a modern psychology that just happens to translate mathematically into the stock market. So it's something you should always throw up there. Is it a science? No, there's no, there's a golden ratio, but there's no golden rule saying, oh, this is going to work every single time. But it's just been fascinating to use this novel, is it an indicator? I don't even know how to describe it.
Because it kind of ties into price action and chart patterns, which really aren't indicator work. So I don't know what I'd call it.
Yeah.
But the way I was taught, let's use the most recent example here. So we have this high up here, February 19th, and we have this low down here. We draw the line in the middle, the 50%. So as soon as it comes up to the 38.2%, which is a little bit lower, that's where the shorts start getting interested and saying, okay, I can short again, all the way up to the 50% line. And they might short all the way up to the 61.8, but above there, in theory, that's when they get blown out. And if it goes above the 61.8, you have another one at 71 or 74 in there.
Yeah.
But usually, I've seen in the big ones, if it breaks 61.8, it's back to those highs, and that's because the shorts get blown out, and you got that short covering rally. So
yeah, it's very fascinating. I wouldn't say, hey, just go out there and use Fibonacci levels. I would never teach that. You want to have other indicators to back up those numbers.
Like what, for example?
What for me, my two go-to indicators are relative strength index, the RSI, things that are overbought and oversold. So
like momentum.
Perfect example, momentum indicator. So the RSI, when we sold off that 50% retracement in the Fibonacci level, the RSI was oversold in the S&P 500 at a level we hadn't seen in years, and then it started to turn. When you see an oversold condition turn, it's measured, oversold is 30, overbought is 70, it goes under 30, it comes back above 30. That retracement back above 30 is a buy signal to the technician. So you had a Fibonacci level hold, you had an RSI that was showing a buy signal, then you had a MACD, moving average convergence divergence. We're putting
don't even talk about anchor VWAP.
Don't even get me started. There's so many different things, but to keep it as simple as possible, which I implore people starting in technicals to just keep the process simple. If you have too many lines, too many squigglies on your chart,
indicator fascination is a thing, an indicator overload, because I've been through that stage myself, and it's no fun, because then you got a million lines on your
screen. Can't help yourself. I've seen your screen.
And that's after indicator fascination. You should have seen it before.
Jared looks like a serial killer when he puts all these lines on it.
Million screens, million computers.
Keep it very simple, and then and then everyone that's trading and using these technicals, you find what works for you. Everyone has a different process. I don't use Ichimoku cloud, but you can put a cloud up there. You can use GAN, you can use Elliott wave. There are so many different techniques that work for the individual. It's studying them, putting them in your process, finding what works. But Fibonacci, speaking of what has worked, has been a key level and something that every technician has to be cognizant of going forward.
What markets are you looking at right now? And we're going to get into some earnings stuff after the break, but what do you like in terms of sector action? So it looks like we might be getting back to highs.
Yeah.
What are you looking at for opportunities?
Yeah, right now the sector action, it's been very defensive. So the business cycle's coming into play. What is leading? Well, it's not really leading. The staples are up a little bit. Utilities are up a little bit. They're just not going down as much. Just overall, let's just go the whole year. In April, we're seeing a rebound. April, we saw a rebound in the most beaten down sectors. So a mean reversion. You see, technology finally coming back after beaten down. We'll talk about the Mag 7 a little bit. And then the discretionary names. Tesla was the one who makes the biggest component of discretionary with Amazon. That was down 50% from its peak. It rallied back. So you're going to see the index, the discretionary index in this case, rally back the most. So we're seeing a little bit of mean reversion, and we saw a washout, and now we're trying to find our sea legs, get that floor beneath us. That's what the story will be going forward in May, June, and July. Are the lows in? Are we going to retest them? I think the lows are in, but it doesn't mean we're going to have that V-bottom recovery and go right back to new highs. There's been a lot of technical damage done. There's crazy fundamental headlines coming out minute by minute. So right now, this is a market that people want to try to find a comparison to. The two easiest ones are ones we lived through. 2022, we had a nice bear market, and we had a sell-off, we rallied. We had multiple sell-offs of over 10% during that time. And then COVID. This isn't COVID, but it's got a lot of those feelings given the volatility in the market, given a washout bottom and a bit of a rally. Can it continue?
And then the story, you got supply chains in flux too. So
that's another story to watch going forward, no doubt.
Hold that thought. We need to take a short break, but coming up, we're going to be talking big tech earnings, still propping up the bull market, and a runway showdown featuring stocks and jocks. Who's got the better game day look, day traders or sports bettors? This episode is brought to you by the number 15.9%. That is how much the street is expecting the earnings or profits of the Magnificent Seven stocks to grow this year. Meanwhile, in the other 493 stocks in the S&P 500, expectations are for about half of that, or 8.3%, according to FactSet. So this stark contrast, it kind of highlights the heavy lifting that big tech continues to do to prop up the broader market earnings. And we're only starting to learn the impact of tariffs on all of these companies. So what do you think of the stock price reaction to the big earnings we've seen so far? And disclosure, everybody, we haven't even seen Apple. I don't think we've seen Amazon yet. So we got a little bit to go, but what do you think?
Yeah, as we tape this, we're waiting on Apple, Amazon, Microsoft, and Meta, and then NVIDIA in the hopper a couple weeks from now. So we haven't seen the big ones yet, but what we're seeing is solid numbers, but no guide. So the numbers can come in line, and that would be fantastic. We're looking backwards. What the market does is looks forward. So we want to know, all right, what do you see in the future? And what do they see? It's cloudy, it's murky. They don't know because the guidance can't be given because the tariffs haven't been certain, haven't been solidified. We're still negotiating things right now. So we'll look for the Mag 7 numbers. If they come in line, which I anticipate they will, then that will prevent us from going much lower, which is good. To start an uptrend, you have to stop going lower first. I think we've started that process, but to see us rebound, get to old highs, if our numbers come in line, it's not going to break us to new highs until we get some clarity, some guidance, and maybe a blowout number. Who knows?
So as an investor, how do you navigate all of that uncertainty, especially when you don't have guidance?
If you're not a day trader.
Yes.
If you're not a day trader.
If you're a long-term investor, you're trying to find those pockets of opportunity, but like you said, we're not receiving guidance. So it feels like you're flying blind right now.
It's tough. The long-term investor, you still buy what you know, buy what you utilize, and put it away as long as the long-term story hasn't changed. I don't think the AI story is going away anytime soon.
Right. The fundamental picture is still there.
It is. It may pull back a little bit. We may see them spend a little less. Ad spend in a Meta, we saw it in a Snapchat, should be reduced as people navigate these waters. But the long-term investor should know that when we have corrections like we've had over the long term, these are opportunities. So if they did have a shopping list and they did buy some of these stocks on sale, I mean, every one of the Magnificent Seven was down over 20% from their peak.
I asked Jared every day, I say, is it now the day to buy NVIDIA?
What have I said so far? I don't even remember.
I think no, not yet.
I have not bought any more NVIDIA. I want to talk about, we've been talking about bottoming as a process, and that's what it is, and topping is a process too. I think the pandemic kind of, and a lot of people only remember, they're kind of inured with this sense that their first bear market is what they remember, and the pandemic was so quick to get back up to record highs. That's not always the case. In fact, that's rarely the case. And so there are some market analogs. People say, well, today in 2025 might be like 2001, and you draw the chart and side by side. So we're right here in the very beginning, and then it goes like this, and the NASDAQ goes down, down, down. Yeah. Are you at all concerned about that? Do you follow market analogs?
Oh, I do. And bottoming has different forms and formations. And sometimes you just see a quick washout and you get a snapback rally. And we did see that. We had that washout capitulation. The VIX almost hit 60. Yep. That's a record high for the VIX. 65% of the stocks in the S&P 500 were down over 20%. We didn't hit official bear market territory, as they label things, where we had to close 20% below the high in the S&P 500.
That's a media definition.
Intraday, we did close, and when you live through it, this was a bear market. Yeah. Whether history recognizes it, that's up to the historians. But, we are now trying to find that bottom. And the question is, do we have a retest? A lot of bottoms. You make a low, you rally, but you know what? We're not out of the woods. We're going to retest that low and get back to levels where we were. And if it holds, all right, that's a double bottom. Here we go. And then we have a long process of recovering. When there's serious damage, when earnings growth slows, when companies like a Nike and a Disney, two iconic companies, both in the Dow Jones Industrial Average, both trade right behind us, those stocks are trying to find the low. Every time they get a rally, it's sold off. Solar stocks, another example. You rally, just sell them. So we're seeing bases, we're seeing bottoms trying to be formed, but we haven't seen the turnaround. So fundamentally, in a company like Nike, in a company like Disney, Disney's going to get a new CEO at the end of the year. Maybe that'll be the turnaround. Nike has a new CEO, but now they have tariff issues. How is it going to bottom? What's going to happen? Each individual stock will have its own, story behind it. And then the indexes, it's the economy. And right now, if we do go into recession, that bottom may not be in, and that bottom may take a long time to dig out from. So we'll see where it goes. But right now, we have a nice tradable bounce, a relief rally, and
got the momentum low.
Hopefully,
not necessarily the price.
Momentum low, maybe not the price low, and we could retest that in the coming future. But right now, things have stabilized going into the back half of Q2.
Bringing it back to earnings season here, how do you trade? How have you traded earnings season, especially in high volatility like this? Do you look at the reports? Do you study what happened, like how a stock reacts historically, or just kind of watch the tape?
Okay, well, I was a trader down here for 28 years, and we had a strict rule, no positions into earnings, because it's the most unpredictable time. Yeah. You don't know, hey, they can beat, but the guidance is horrible. So as a trader, I would not get a position and gamble, because you're kind of wondering, okay, are they going to beat? How's the guide going to be? We've seen it in stocks like NVIDIA, where they beat and it goes up, and then by the time it opens,
I was talking about after the earnings is released.
That's a different story.
Are you a day trader at all?
Day trader, I'm not allowed to day trade like I once did. But no, I look for gaps. I look for levels of support resistance. To me, gaps, up out of a range, down out of a range, they give me opportunities to go long, to short stock. So that's how I react to earnings. And when you gap up, like in Netflix is a perfect example. Their earnings were a couple of weeks ago. It gapped up. And guess what? It gapped up on a bad day. And it was making new highs, but it didn't follow through. But it held that initial gap, that first price. Once the market rallied the next day, that thing was up 70 points, a little over 7% at the time. So gaps tell stories to me, and then if they start to fill, it's a head fake. So to me, when you're trading earnings, you have to be very careful. I always have risk management tools in place. I use stop orders, trailing stops to lock in a profit, sell stops to minimize a loss, and that way I have longevity. I've been doing it for 30. It doesn't matter how long I've been doing it. Been doing it for a while. And risk management's always the most important thing to me. So when you trade earnings, you have to have a game plan and then be ready to rip it up and get out if it doesn't go your way right away. But gaps on earnings always give me a little bit of an advantage.
Now, how are you looking at valuations too? Because stocks are still very expensive. You're just talking about Netflix, and that has been one thing that analysts have been talking about, right? Is it priced too high? Is the valuation too high to support the fundamental story? And they've been doing well. Guidance was solid. They continue to really be on the pulse of the streaming wars, but how do you factor in the price of a stock when you're looking at all these different indicators?
Yeah, you look at historical valuations. As a technician, we don't even, I could just sound foolish and say, I don't even look at these things. But I do. I understand how these multiples will fluctuate and they'll get overdone in jubilant times. And when we were going through the .com and even this bear bull run, they were a little excessive, over 25 times. Now we're getting to more historically normal levels with valuations. So for a value investor, now may be a good time to get in, because when stocks gain momentum, if we have another rally back in the tech story, which I believe we will, growth is definitely not done, the valuations will get a little heated again. So I wouldn't base things on valuations, but what I do look for, historical valuations. And now we're at more normal levels. And if you're looking at high growth, these are times to get in. I mean, and Tesla's valuation is still ridiculous, but that's another story for another time.
All right, we only have a couple minutes left, so I do want to get into this week's Runway Showdown, and it's all about high-stakes performance under pressure. First up, A to Z day trader. Coffee-stained shirt, sleeves rolled up, eyes darting between 6 glowing screens, fingers hovering over keyboards ready to strike with adrenaline-fueled agility. This market warrior lives for volatility, thriving on charts, breaking headlines, and split-second decisions that can make or break fortunes in moments. And stepping right behind, the sports bettor, decked out in analytics chic, armed with spreadsheets, injuries report, and unshakable belief in their system, calm and calculated, yet always aware of the unpredictable bounce of the ball. They place wagers with the precision and the poise of a veteran quarterback calling audibles. So Jay, who's got the better game day look for investors? Is it the day trader chasing market swings, or the bettor playing statistical probabilities?
Well, it's about statistical probabilities, and being a professional trader for years, I'd always go with the trader on this one, knowing those risk reward. Sports, a lot of chance, but there are metrics, there are skill sets. I was just at the Phillies game with my son. We were betting pitch by pitch. You could bet, is the next pitch a ball, is the next pitch a strike? Is Bryce Harper going to hit a home run? 19-1 odds, and I couldn't get the bet in time, and he did. Oh my God, yeah.
Never go against Bryce Harper.
Don't interview my son. He's still mad at me about that. But so there are a lot of similarities, and sports has taken on that statistical probability. So you will dive into those stats, and it's very fascinating because those two worlds are very similar. The only thing about the sports gambler that I've noticed is they risk a little too much. When you lose your entire bet. The stock trader, they'll lose a percentage bet. So they don't win as well as the sports gambler, but they maintain longevity. Where the sports bettor, it can get a little more emotional, not that trading doesn't. And there's a little more chance as far as I'm concerned. But those two worlds, very similar. And I think they're going to continue to collide as sports betting and statistical probabilities continue to be ramped up when you look at these numbers.
Stocks and Jocks, Jay Woods, thank you.
Yeah, you got it.
And that does it for this episode of Stocks in Translation. Make sure to catch us on all your favorite podcast platforms. Thank you.